The yen is more than 1% stronger because traders are less convinced that the Bank of Japan will on Friday unveil a big package of fiscal and monetary stimulus. Well, one bank that has been consistently predicting the BOJ would actually not do anything this week is MUFG. And with us from MUFG is Derek Halpenny, its European Head of Global Markets Research. Derek, the problem for the BOJ is whether they've got the tools to do the kind of thing they need to do. Where are they on that?
Well, I think the timing is hugely important now, as you can see, in terms of the scale of quantitative easing and the buying of JGBs. It's been huge, and therefore they need to be very, very careful in terms of the timing of when they announce any extension of that. So our view is that they're going to remain very, very cautious. Perhaps what they want to see is more steps taken on the Abenomics side of policy in Japan, and therefore they may wait until we have further details of fiscal stimulus and hopefully some other reform measures in regard to the third arrow of Abenomics, and then perhaps later in the year, maybe at the October meeting, that would be a more opportune time to extend quantitative easing.
Dollar yen, it's actually been weakening, strengthening recently, and now it's again today weakening. What's been driving it? Let's have a look at our next chart, which illustrates this.
Well, certainly, if you look at nominal interest rate spreads, that's the very quick way in which dollar yen tends to respond. So the US data has been strengthening, and perhaps tomorrow when we get the Fed statement, there'll be an upgrade on the economy after the labour market has picked up. Two-year yields have pretty much, in the United States, two-year yields have pretty much reversed the Brexit drop.
Right.
And that helps lift dollar yen.
So that's one element, but the next element, which our third chart shows, is that actually it's more from the Japan side, isn't it?
Yeah, like we're wary of putting too much emphasis on the nominal interest rate differential. And really, as you can see, during Abenomics, it wasn't really nominal yield spreads that drove dollar yen higher. It was real interest rate spreads because Abenomics lifted inflation expectations in Japan. The problem since the beginning of this year is that Abenomics has been unraveling. Inflation expectations have plunged, and actually on a five-year inflation swap basis turned negative earlier this month. So real yields have been rising in Japan, and therefore that has helped to lift the Japanese yen.
And that stronger Japanese yen, as our final chart shows, is actually creating a big current account surplus, isn't it?
Yeah, indeed. Like in terms of what, obviously if you have a surplus of this side, the exporting of capital on the financial account is even more important to try and weaken your currency. And if you have rising real yields domestically, that's creating problems for encouraging both households and corporates to invest abroad. Or what's been happening is the investment income on assets abroad, more of that money is being converted back into Japanese yen, and that's helping to lift the yen.
And just finally, Derek, I mean, you say there might be action by the BOJ, say, in October. So where will the yen be by end of year?
Well, we still feel that perhaps even by then the action might not be aggressive enough, and we're looking at the influences that I've just pointed out as keeping the yen on a stronger footing through the remainder of this year. So we could be at levels at around 100 or even below by the time we get to the end of the year.
Derek Halpenny, thanks very much.